Okay, welcome to the Trading in the Noise YouTube channel. We're going to go through a little experiment here of try to play out what would be the best way to play a down move. We've got a couple of trades set up here in OptionNet Explorer, and this is a program to where we can go back in time and we can take a look at options positions and see how they worked, see how they behaved. So I chose this day. This is a very technical. This is a very technical level here. Let's see. We'll get this one up here. One set up on this one, right? Okay. So, anyways, if we look here at this day in the SPY. We've kind of had a sell-off, and then we bought back up, but we came back into this consolidation zone, and we threw an inverted hammer. I don't know if you call it a hanging man. It's not a hanging man. It's some sort of doji. I don't know. So this is a technical area that could be a place to sell. It opened, if you look at this, it went above the 20 moving average, came back down and closed below it into this consolidation area. So this could be a decent place to go ahead and get short in the market. So we're going to find out what would be the best way to get short. And so we're just going to assume we got $1,000 to make this trade. Okay. So we have all of these ways set up. I got these all set up. So if we just take a look at the three at the money, and I don't know what happened. I just set them up. I haven't gone into the future to see. And we're going to say what happens at expiration here, because I set it all up for 7 days. 7 days to expiration trade. So we're going to go ahead and we'll take a look and see what happens. So we can, let me just give you a little rundown upon what's going on with all of these. So basically, we're assuming we got $1,000 to trade this one, or roughly $1,000. I think I went a little bit over on some of these, but just over $1,000. So we're just saying an at the money, just straight put, and I'm sure that one's going to do the best because I know what happens. Anyways, and let's see. So that's just basically buying 3 puts, and that at that cost at 381, that gives us a net debit of $1,141.50. So we're going to say 10 puts at $1. Okay, so we're going to be buying. We went out to what put cost us $1, and we bought 10 of them. Okay, and then so we're going to do 6 at the money put debit spread. So we're buying 1 at the 405 and we're selling 6 out. Now the total cost on that one was right around $1,125, just over $1,000. You can see the risk graph on that. And let's go to the at the money call credit spread. So this we're going for some debit credit spreads now, not debits. And of course, those credit spreads are going to put the odds a little bit in your favor, but they're going to make a little bit less money. So, like if the stock goes up, you'd be okay, So that's an at the money one. So we sold the at the money, and we bought the $5 away. That gave us a net debit or a net credit. It gave us a net credit of $828. That's going to be the max we can make on the trade. Our max loss, which is going to be the margin that the broker holds, is going to be $1,180 on that if we let it go, if we would let that go to expiration. And then we're going to do a 1 standard deviation call credit spread. And go on out here to the 1 standard deviation. And we're going to just be getting 50 cents per trade. So this is a very popular thing. Now, this is going to put the odds. This is probably going to have the best odds in your favor right here because your break even's all the way up here in 7 days. So let me bring that price chart back up. Let's say SPY goes up and You see, where's the point to break even at? Is going to be 413. That's going to be right up here in this region. So it has to basically make it through this consolidation zone in order to get there. So that's going to be a pretty decent trade to put the odds in your favor. And then what we did is we did a put butterfly. So it's a different type of trade structure almost. And you can see you're going to have a max profit of 4,000. Now I just spread it here just as a $10 wide. See, we bought the at the money put 7 days out, and then we sold one $10 away, and then we bought another one just to kind of cap the risk off. So you can see the max profit on this one is if we end up, right there. So we're going to move forward 7 days just to see what happens. We're going to move to expiration, the next expiration day, which is going to be March 13th. That's a Monday out. And let's just take a look and we'll go through these. We'll see what happened. So as you can see, those 3 at the money puts made $4,400. Let's see. Let's take a look and let's see what happened a week out. So you can see we did have a sell-off, and the at expiry at the week out near market close, $4,406. That's pretty good. That is a pretty good return on $1,000 trade. That's going to yield you 4 times your money. Okay, let's see what the dollar puts, and we got 10 of them. And you see, this one made twice as much money. This one made twice as much money as that one did. 8,000. We got more leverage on this, and that one made $8,000. Okay. Let's see what happened here with the 6 at the money put debit spreads. You can see this is where we wound up. Going to be max profit on that trade, 1,880. So that's a little bit better than well, it's not quite making 100% on your money. And let's see. So the at the money call credit spreads, of course, those went to max profit, $828. And then the one standard deviation is going to be making max profit of $135. Okay. Let's see how the at the money put butterfly did. And this one actually wound up losing money because SPY went too far. SPY went way too far. You could have closed it out earlier in the day. So butterfly trade, it's definitely going to have to be managed. Okay. So that's that. So now you might have a better idea of how to play things. What was the winner? I mean, as far as profit is concerned, is going to be this one. Now, this one takes into account because SPY made such a great move. Now, let's say you get a bad signal. Okay. Let's say you think something's going to happen and it doesn't. Okay. It doesn't happen the way that you think it will. This trade's going to lose money every time. So this one actually, it got you more leverage, and it made the most money. That was the winner there. So 10 puts at $1. If you're willing just to lose $1,000 on the trade, that's going to be your best bet by far. Okay. Okay, so now we're going to set it up at another trade. Very similar setup. As you can see, we're coming along here. We went up into a consolidation zone and through a bearish candle. And so we're going to see what happened on this day. So we've got it set up. pretty much similar trades. We've got the at the money long put. We were able to buy 2 of those for the $1,000 this time. $10. So that's basically 10 puts at $1. And that's what the risk graph looks like there. The at the money put debit spread, same setup. The at the money call credit spread. So this is a credit spread, and we're using calls this time. And then of course we're going to use the 1 standard deviation call credit spread. And the at the money put butterfly. And everything costs $1,000 every one of these trades did. So let's go, and we'll just move 7 days forward to the expiry to when all of these options expire. So let's go up here, and 7 days is going to be a holiday, so we're going to have to go to the 17th on that. That's 8 days out, but it's similar because it's the same trading days. So as we can see what happened here in the price chart, this was our signal, and you can see that signal failed. So, I mean, there's lots of different ways we would get out of this. I mean, you wouldn't let these things go to expiration, none of them. But just to illustrate the point. So the at the money puts actually lost the $1,000, lost the whole $1,000 you put into it. The $10 puts, they lost everything too. The at the money put debit spread, that lost everything. So the call credit spread, it went too far up. Call credit spread expired worthless too, or not expired worthless, but expired at a full loss. So the 1 standard deviation call credit spread, you see what happened here. That's a full winner. That is a full winner of the $188. Because we didn't move 1 standard deviation up, and that's where we expired right there. So that's a full winner. The at the money put butterfly, of course, was a full loser again as well. Okay, so now we're going to see what happens if we use a further dated expiration. Instead of the 7 DTE, we're going to go ahead and use a 30-day DTE on this trade that actually did not work out. So let me show you. Take a look at the price chart, came into a region, threw a bearish candle. We'll see what happens. Okay, so let's take a look at the at the money put. Let's go ahead and roll all this forward just to 7 days. We're not going to do the 30 days. We're going to go ahead and do 7 days first. So say to the 17th. You can see that one's down $536. So about half of it's gone. Half of the money's gone on that one. Now let's see what happens if we take it out. Now let's see what the at the money put debit spread done. So 468, same deal. About half the money's gone. Doing a little bit better. The 10 puts for $1. Now we had to go way down to purchase those. You can see those have lost quite a bit of value. 770. Still not all the value's gone. So the at the money call credit spread. Let's pull this one up here. That's the one where we take it at the money. And you can see 7 days later, about $380. So not half the value's gone. About a third of the value's gone. A little bit more than. Let's see what the 1 standard deviation call credit spread is like. That one's only down $56 7 days into the trade. That one's pretty good. Okay. And then the at the money put butterfly. That one's down $284. So about a quarter of the value of the put butterfly is gone. Down in the put butterfly, we used we got 8 contracts. So you see, there's so many different ways to play options, and to say, one way is better than another way. It looks like the butterfly's not as good, but if you're going to be exiting early, that could be a good trade. It has a pretty good directional bent to it. But there's so many ways to play options trades. just depending on what you're trying to do.